You know we're online.
Yeah.
Thanks, Dan.
Yep, we're online now, Chair.
Good afternoon. Welcome to this virtual meeting of the Teesside Pension Board. I'd remind all participants that the normal rules of procedure apply, and that while members of the public can view this meeting via YouTube Live, they won't be able to actively participate or comment on proceedings. The agenda and the papers for the meeting are available on the Middlesbrough Council website. As this meeting is being live streamed, can I remind all participants that their conduct should reflect this? Before we move into the agenda items, members will be aware that I've received the resignation of Gary Whitehouse as the representative of non-local authority employers, as he's no longer employed by Middlesbrough College. Gary's been a member of the board since its inception. He served as chair, and over the last 2 years, I've been grateful for his support and his input as deputy chair. I'm sure the board wishes him well for the future. I'd like to welcome Paul Thompson as a scheme member representative, and also Councillor Chris Hobson has resigned as an employer representative, and I'd like to welcome Councillor Barry Cooper in her place. Councillor Barry Cooper has kindly agreed to be deputy chair. That will come up later in the agenda, but lest we lose communication and someone needs to take over from me as chair, Barry Cooper is in a position to do that now. Thank you. Apologies for absence. We've had an apology from Councillor Billy Eyre, and I think we have everyone else here, if I'm correct.
That's correct, Chair.
Declarations of interest, the usual declaration of interest from me as a member of the Teesside Pension Fund. Are there others? Thank you. Councillor Cooper and Jackie Cook, thank you. Any other declarations of interest of any nature? Yes, Paul. You're on mute, Paul. Were you trying to say something?
Sorry, Chair, I've got technical issues. I might have to switch over to my phone. Apologies.
Okay, right. If you disappear and reappear, we'll know what's going on. Best of luck dealing with the technology. No other declarations of interest then. Thanks. Minutes of the Teesside Pension Board of the 19th of April. I'll get them on my screen and then we'll go through page by page. Page 1, any corrections? Page 2, which is page 4 in the pack. Page 5 in the pack. Page 6 in the pack. Page 7 in the pack. No corrections. Matters arising, I don't think there's anything that doesn't come up elsewhere on the agenda. Any questions from anyone? Anything they would like to raise in relation to the minutes? Okay, thank you. Move on to item 4, which is the minutes of the Teesside Pension Fund Committee of the 10th of March. Any comments or questions relating to that? I just had one, Nick. On page 11, there's a paragraph that says, we completed the first crossing deal, in quotes, leading to a saving of 3.4 million. What's a crossing deal?
Is this in relation to Border to Coast? Yeah. So
Yeah.
this is where one of the partner funds wants to buy units in a particular sub-fund and another one wants to sell units in a particular sub-fund, so they can match them up and they can save on some transactional costs.
Right.
By doing that.
Okay. Nothing else from me? Anything from anyone else? Okay. Then we have item 5, which is an oral report on the latest meeting of the Teesside Pension Fund Committee of the 23rd of June. Over to you, Nick.
Thank you, Chair. Yeah, this was the first physical meeting of the Pension Fund Committee since the 11th of March 2020. We had to hold it as a physical meeting because the government sort of regulations that allowed virtual meetings expired, so we had to have all council meetings that were decision making had to be held in person. So it was in the council chamber. We undertook social distancing. Sue and her colleague did a great job making sure that everyone sat in the right place, far enough away from everybody else. And we had no refreshments. It was hardship. There was only a bottle of water was all that was allowed.
Not shared, I hope.
No, absolutely not. We had to wear masks before we sat down, etc. It was also affected. COVID also affected the meeting because the advisor Peter Moon couldn't attend because he was isolating due to coming into contact with somebody, so he was unable to travel to the meeting. We also tried to keep it as short as possible. That was my intention. I failed miserably. The meeting lasted about 2.5 hours. But on the plus side, that meant there was some good engagement and discussion to be had. But basically, to give you an update, the fund, in terms of the paper that Wendy did, the investment paper that Wendy prepares, that just shows that the fund continues to favour growth assets over protection assets and has no investments in bonds. Our cash levels had gone down to about 7.5% at the end of March. We didn't do any property transactions during the quarter, not through want of trying. We're still on the lookout for direct property on an opportunistic basis where we can find it and it gives us what we want. We continue to invest in alternatives, so private equity and infrastructure. For example, we invested about 36 million in the quarter in alternatives. And at the end of the quarter, at the end of March 2021, the value of the fund was about 4.5 billion, was just over 4.5 billion, which was the highest it had been, which was quite a good bounce back from a slump at the end of the previous year, effectively. So financial assets had gone down. Our equity had gone down significantly at the end of March 2020. They'd recovered and beyond by the end of March 2021. I don't want to comment on what they're doing today because that's a bit rocky as well, I think. Wendy's biting her fingernails, which isn't a good sign. Yeah, so there's still a way to go, obviously, in terms of getting out of the financial implications of the pandemic, but in terms of the assets of the fund, they've recovered to a large degree, or they certainly had at the end of March. Other points of note at that point we were in the middle of transferring 1.3 billion pounds from passively managed equity to actively managed equity. This is something that the committee had agreed to a while ago, that we could transfer the money. Most of our overseas equities were held with State Street passively, and that's not a natural position for the fund to be in. We usually prefer active management, so we always said we were going to transfer most of that back to Border to Coast once the Border to Coast fund was more established, and we'd come to an end of a particular deal that we had with State Street. So that transfer is now complete. At the end of March, it was sort of halfway through, and that means that at this point, at the end of March, half of the fund's assets were invested through Border to Coast, and now that figure's more like 60%. So we've got a significant proportion of our assets invested through Border to Coast, largely through equity. But also worth noting that we've continued to make commitments to alternative investments, and at the end of March we'd committed approaching about 930 million pounds of commitments. But the board's probably aware that, or maybe aware that it takes a time to actually get committed money into invested money, and so what we've got actually invested with managers in equity and private equity and infrastructure is more like 300 and odd million. So about a third of it has actually been properly invested, but we've made a commitment to make those payments to those companies and to do those investments. And over time, we will be selling our publicly held equity to get cash. And one of the reasons we're doing that is because we'll need the cash to pay for those investments in private markets. So that was the investment update that we gave the committee. We also had reports from State Street and Border to Coast, which we have every quarter, and these pretty much showed that State Street, as a passively managed fund, did exactly what we were expecting it to, which was track the indices that it's matched against. And Border to Coast also pleasingly sort of continued to meet their investment targets over the period we've been invested with them, which is to beat their benchmarks by about 1% a year on average. So that's good. We didn't have a presentation from Border to Coast, but that's because I'd advised them that they didn't have to come in the circumstances to physically attend the meeting, because there was no decisions to make about our Border to Coast investments. But they did provide a presentation, which is obviously available in the agenda for that meeting. And some of that was just an update, which was quite interesting. So their annual update showing that they've got, out of the 11 partner funds, they've got about £22 billion of assets under management now, and also commitments of about 5 billion to invest in private markets. And also they employ now 100 people, which is a sort of significant milestone. And it's a few more than we expected them to employ, perhaps at this stage. But partly that's a consequence of the complexity of investing, and also because of the success, really, and the fact that partner funds have been willing to, for example, commit £5 billion to them to invest in infrastructure and private markets. So they need to staff up to that as well. So that was interesting. Also, Border to Coast have got a proposition around real estate. So they're interested in investing in real estate, in property. So there's a demand for that from their partner funds, and members will be aware that we already invest in property ourselves directly. We own 28 properties across the UK that we get rent from, and that we get hopefully capital appreciation from as well. And the Border to Coast have got a proposal that would, if we agree to it, if the pension fund committee agrees to it, would involve transferring our property portfolio to them to manage, along with a number of other property portfolios from the other partner funds. And there's also a proposal around overseas property investment as well, which Border to Coast want to bring forward. And the September committee will be hearing that property proposal, and you'll hear a bit more about it after that, I guess. We also had reports from William, not from Peter, because he wasn't allowed to attend. Peter provided a paper report to the committee, and William attended the committee. William was concerned really about the current economic implications of the COVID-19 pandemic, not surprisingly. He's also concerned about the potential for inflation. Now, if inflation picks up, as it already has started to do, if it's a long-term issue, then that's quite significant for the pension fund, because our liabilities are linked to inflation. So all the pensions that we pay increase in line with inflation. All the members' career average benefits increase in line with inflation. So if inflation is high, we certainly need to make sure that our assets grow at least in line with inflation, and probably more. So that's something to keep an eye on. It's particularly a concern for us because in the short term, it's looking like it will be holding quite large amounts of cash, because the board might recall at a previous committee meeting, we agreed to reduce our equity holdings, which are above target. And one way we're doing that is, the simple way of doing that is selling equities, and you end up with a lot of cash. Now, obviously, you don't want to sit on a lot of cash for a long time, because inflation erodes the value of that cash. And so that's something that we are working with our advisors to understand what the best approach is. We also had a report from CBRE, the property manager. They were explaining that the outlook was improving and positive, although the UK economy is about 8% below its pre-COVID level still. and different property sectors are behaving differently. So logistics, for example, sort of retail warehousing is doing very well, perhaps, whereas some retail isn't doing, high street retail isn't doing quite so well, as you'll probably be quite aware. So they're keeping a watching brief on that for us. And there was a report from, I've actually skipped over one of the reports, which is because it's on this agenda. There was a report about the funding strategy statement, which we'll be talking about later. There was also a report from XPS, which I can see Paul Mudd's joined us. They'll be providing a report on that. Paul will be providing a report on that later as well. There were also a couple of reports relating to local investment proposals. They were in the private part of the agenda, and I don't propose to go into any detail about them here. But if members are interested, I can obviously speak to you later about that. So that was it from the committee meeting.
Well, thank you, Nick. Any questions for Nick? You mentioned, and I mean we're aware of it. We've talked about it before, of the commitments that we've made for future funding to Border to Coast. How much notice are we given in practice when Border to Coast need to call off cash from us?
Well, it's I think a week is the minimum, isn't it, Wendy, that they're supposed to give us?
They're supposed to give us 5 days. Yes.
Yeah.
Unlike other funds, yeah.
Yeah.
Give us 10.
So five working days. So we've got to have that money pretty much ready to pay effectively. We can't have it in any investment that'll take any time to get out.
So the quite substantial commitment that we've made to Border to Coast for cash in effect that hasn't been called off, we can't do much with that at all. We can't invest it. We can't put it in any long-term bond. So it just sits there and earns nothing, presumably.
Well, at the moment, that's what the sort of treasury management function is for, if you like. We do try and invest it, and the reason that we're not getting much return at the moment is a feature of how low interest rates are, effectively. It's certainly, we're getting a lot less now than we were even a year ago or 2 years ago, because interest rates have dropped.
Yeah.
But we do actively try to do things with the money. We typically lend it out to other local authorities, for example, but not at very high interest rates, it has to be said. But the default position is for us is to keep the money with the government's debt management office, which at the moment, well, when I looked a couple of weeks ago, it was giving us 0.02%, I think. So nothing you would really notice. Yeah. But I mean, but the reality is, though, although I'm telling you that we've got sort of hundreds of millions of pounds ready to invest, the reality is there's no chance that they're gonna call for that all in one go. It's going to be phased and staged, so it's reasonable for us to keep some of it ready and to invest some of it.
Yeah.
So in practice, go on.
I was just going to say, to be honest, the calls that we get, they're not really in excess of £1 million, dollars, euros. We don't get much call for much more than that at a time.
So in practice, we only need to keep maybe 1 million or 2 million available at any given time.
A bit more.
There are other expenses that go out. Yes.
Yeah. Okay. And you also mentioned Border to Coast are employing rather more people at this stage than was originally anticipated, which we can sort of take as a measure of their success. What are the financial implications for us of the fact that they're employing more staff?
Well, there shouldn't be very many direct consequences for us, because they're employing more staff because they're investing more money, if you like. And so because ultimately the cost of employing the staff is spread across the amount of money that's invested, and you end up with like a cost of Border to Coast, if you like, which is 0.03% of your whatever you invest, or whatever the number is, then as long as it's proportionate, it shouldn't have any significant impact on us.
Yeah.
Where we should get concerned is if they're employing 100 staff and they're investing half the money they said they were going to.
Okay. And inflation, presumably the crunch time, the first crunch point for us will be the triennial valuation next year.
Absolutely,
right?
yeah, absolutely. And it's really to do with what the actuary's view is about long-term inflation. And that's sort of very long-term inflation, if you like, because that's what they put into their assumptions. So if the actuary thinks this inflation is just a blip, it's going to resolve itself in a few years back to normal levels, then that won't be a concern. But if the actuary thinks, oh, hang on, there's a chance that this will continue and become structural and we'll have, you know, 5% inflation going forwards for a number of years or longer, then that will mean they'll alter their assumptions and say that the cost of our liabilities is higher. So yeah, so that'll be an issue.
I know it's early days, but do you have any emerging feel for how actuaries are viewing inflation for the future?
Not yet, no. No,
Okay,
I don't,
okay.
unfortunately. That we're about to go through a process of, actually, within the fund, we're about to go through a process to reprocure the actuary. So we might not have the same actuary at the next valuation as we did at the last one. But whatever happens, we will be engaging with our current actuary or a new actuary in very early in the new year to talk about financial assumptions for the next valuation.
Yeah. Okay. And the last question from me on this particular item, talking about the large amount of cash that we hold at the moment, for reasons that you've explained, how responsive can the committee be in terms of changing its view short term to take account of any issues that might be arising from it in inflation? I mean, I'm clear that over a period of time, there's been an agreement, and this board has talked about it a number of times, as well as the committee. There's been an agreement that the asset allocation strategy should be changing. Inflation, I think has come. I mean, perhaps economists could have predicted it, but I think probably most of us so far haven't been anticipating the degree of inflation that is now being suggested. Is there scope for the committee to be responsive and to change its approach in a fairly swift timescale?
I think there's a bit of scope for the committee, but there's also scope for me and my team and for the advisors, if you like, to operate responsibly and quickly if we see something happening and there isn't time to wait for the committee cycle to do it. The way that we're set up allows that to happen. Ian has got delegated authority. My boss has got delegated authority to take action where necessary. I'm not expecting it to happen like that, but obviously we'd like to do things in a planned and measured way. But if for some reason we needed to take some urgent action relating to our cash and we thought there's something happening to it, then we've got the power to do that.
Yeah. Okay. Thanks. Any other questions for Nick? Okay, we move on to, I'm wrestling with my screen. Agenda item 6, pension board membership. I've already reported Gary's resignation as a member and therefore as deputy chair, and reported that Barry Cooper has kindly agreed to take over as deputy chair and chair from the next meeting. Nick, would you like to take us through the other items on this paper?
Yeah, I'm trying to see what's left. Yeah, so the recommended purpose of the report really was to ask the chair to appoint a deputy chair, which you've done. That's great, from the employer representatives, and to update you on progress and proposals to fill vacancies. On that front, there is a vacancy. The vacancy left by Gary. We advertised that to all the other employers, with none of them putting the names forward as yet. So so that means that I am able to take a more targeted approach. They've all had the opportunity to put themselves forward. So now I need to try and find some people who I think might want to put themselves forward, who could be persuaded to put themselves forward. And it makes sense to me to do that based on size of the employers, perhaps. We have some big employers in the fund other than the councils. It would make sense to me to have one of those that's got more invested, if you like, in the performance of the fund and monitoring the performance of the fund to put themselves forward onto the board. So, for example, Teesside University has a lot of members in the fund, and there are others. So my next step is to target them. The other thing was just to remind the board, which the chair has already, that with effect from the next meeting, the deputy chair will become the chair, and then we'll need the chair to pick a deputy chair from amongst the scheme member side of the committee board. Sorry.
So from that point of view, it's going to be important that the recruitment of the two places takes place fairly swiftly, so
Yes.
that there's a decent choice for the chair to make his decision from.
Yeah.
It's interesting, isn't it? I mean, we're moving into a period where there's been a lot of turnover of board membership. I mean, from the end of this meeting, Jackie will be the one person who's stayed with the board since its inception. Hopefully there'll be a new stage of continuity now, where there won't be so many changes of membership in a short period of time, because as members who've been associated with this board, or indeed with the pension committee, will be aware, there's quite a lot of learning and understanding that needs to take place, and it's important really to get as much continuity as possible, and to be able to draw on the experience of those who've been on the board for some time. So it's to be hoped that for the future we'll get a fairly sort of steady membership, at least for the next 3 or 4 years, I hope.
I guess one thing I glossed over there was paragraph 5.2, which was about the fact that your term of office comes to an end at the end of this month, and that we're going to go out to all the fund pensioners. So that's 23,000 people, perhaps, to ask them if they want to be the pensioner representative. And we'll likely publicise that online, and also through a pensions newsletter that XPS are preparing, that's scheduled to go out in late summer, early autumn.
Yep. Okay. Yes, Jackie.
Yes. Can I just ask the question? Would that include people who have flexibly retired to request to see whether or not they can, become a member of the board as a pensioner member?
I don't see why not, because they are a pensioner member.
Yeah. Okay. I was just wondering if it was, because obviously they're still employed in some shape or form. Right. Okay. Thank you.
Any other questions? Okay, move on to item 7, the funding strategy statement consultation.
Right, before we move on, I think we should thank Colin for all the work that he's done since the inception of the Teesside Pension Board, because he's worked extremely hard in that time. And I always thought, I'm quite sad that you're going, actually, because I've always thought that you were such a valuable member of the board. So I would think that we should say thank you to him.
Thank you very much. Thank you.
Yeah.
Item 7, funding strategy statement. Nick.
You rushed on quite quickly there. You're too bashful there. Yeah, okay. Funding strategy statement. This is exciting stuff. It's actually quite dry, I must confess. This is the purpose of this. We have a funding strategy statement that sets out how the actuary normally adopts a process to make sure that the pension fund is fully funded, and how contribution rates are set and the interaction with employers. Now, the local government regulations changed recently to put in place some more flexibility for employers and for administering authorities. Typically, when typically what used to happen was we do have employers that participate in the fund on a temporary basis. So as well as the ones like councils that are there forever, in theory, we have employers that are only here for the length of a contract, perhaps. So this would be contractors who have won a contract involving employing people that are in the pension scheme. As part of taking those people on, they have to put people into the pension scheme. They have to become admission body employers and engage in our fund and be subject to our rules and pay our contributions. So they normally pay the contributions, but they will pay the contributions set by the actuary. And what tends to happen is when they leave, or when their last employer, active member leaves, or when their contract ends and all their active members leave, if you like, we have like a termination valuation that the actuary carries out. The actuary comes along and says, okay, we'll look at the assets allocated to you in the fund, we'll look at the liability allocated to you, and we'll work out whether there's a surplus or whether there's a deficit. And quite often in the past, there might have been a deficit. And so if there was a deficit of £100,000, say, we would ask that employer to pay us £100,000. And sorry, you all disappeared then. Are you back? Yeah. Mm-hmm. And so basically, that's what used to happen. We would carry that termination valuation, send the employer a bill normally, and they would have to pay it. Now, what the government's acknowledged is that there were deals happening between employers and funds to allow this payment to be staggered, if you like, and put in place a framework now which says that we have to say how and when we'll allow that payment to be deferred, if you like. And so and then we have to put that information into the funding strategy statement, and that's what this iteration of the funding strategy statement is about. And we presented this to the pension fund committee. We've circulated it to the employers for comment, and the main bits that have changed are set out in paragraph 6. So in 6.1, the substantive changes from the previous version of the funding strategy statement. It explains how deferred employers and their liabilities will be treated. So this is where we have an employer that wants to defer paying this exit payment, how we will treat them. It also, we've put in there an acknowledgement that any employer exiting in future, we will take into account an allowance for the cost management process and the remedy for Mcleod discrimination. So that's some more local government pension scheme jargon for you there. And that's around the cost management process is the process that the fund goes through every few years to check that the cost of providing the fund isn't too expensive. So the government can adjust the cost, if you like, or adjust the benefits to match the proposed cost. So that's going to be taken into account. And also this Mcleod discrimination, we've probably spoken to the board about this before, I'm sure we have. This is where when the government introduced the new public sector pension schemes back in 2014 and 2015, they introduced protections for some members to allow them to stay on the old scheme rules, and that's subsequently been discovered to be, by the courts, to be discriminatory. So there will be changes required to our regulations, which will increase the costs for the employers slightly. So it's about making sure that those extra costs are included within these exit calculations. And as it says there, the expected increase in exit liabilities will be about 0.7%. So it's not huge, but it's worth taking into account. We're also detailing how employers can ask for contribution rates to be reviewed. So this is another thing that's been introduced. Normally, employer contribution rates are set every 3 years after each valuation, and they stay that way. but the government's allowing employers to ask for contribution rates to be reviewed, but only in certain circumstances and only if the fund administering authority allows it to happen, really. And so we're setting out when we will allow contribution rate reviews to happen, and really when we won't allow them to happen, which is we wouldn't allow them to happen if, for example, if an employer looked at our valuation in March this year and thought, oh, that's done really well, the fund's done really well, I want to have my contribution rate reviewed. We're not allowing that. So it's not because of changes in the value of assets and liabilities caused by market conditions. We'll also have to put in place details of an appeals process against all this, which is in the funding strategy statement as well. And we've also taken the opportunity to update the section on risks and control. We've added a risk in relation to climate change and also to COVID-19. And that's the funding strategy statement. So as I say, the next step is, or the current step is, that this is being consulted on. So we've asked employers to give us their comments, and the end date for the consultation isn't till the end of this week. So we haven't reached the end of that yet. But assuming that we don't get any huge differences, or we make any big different changes because of the consultation, then this will just be published on our website, the new funding strategy statement.
Okay, thank you, Nick. Questions? I don't think I've got any questions on the specific changes that have been made, but reading through this document each time raises odd issues, different ones each time, really. On page 33 of the pack, there's a note on orphan liabilities, which says the assets notionally related to the liabilities will be assumed to be invested in low risk investments. And as a consequence of that, the discount rate that it's assumed will apply is 1.3%. Presumably, this is all simply notional stuff, that there isn't a particular block of funds that's allocated against orphan liabilities that then goes into low risk investments.
You're absolutely right. Yeah, that's the case. So we don't have any sort of low risk liabilities like that set aside to pay for these. It's all just one fund, and we have to invest it accordingly. Although if we ever ended up in a position where we had hardly any active members and it was all pensioners and we had more certainty, if you like, then I'd expect our investment strategy would have changed.
Yeah. Okay. Moving on to page 41, which is paragraph 5.1 on the investment strategy. The figures that are quoted in that table relate to the 31st of March 2019. Presumably that's going to be updated to reflect the current situation.
Yeah, there was a bit of a timing issue here because we were consulting on the revised investment strategy statement at the same time, or just prior to this. So we haven't published the revised investment strategy statement. So yeah, I don't think there's a problem with slotting the right table in and changing the date without consulting, if you see what I mean, once we've got the right investment strategy statement and so they align with each other. Yeah, I
think it would be helpful. So we might as well have something that relates to the current situation rather than something that no longer applies.
Yeah.
And I think the only other one from me is Annex A, which begins on page 50. The first set of figures here over recovery periods, the recovery period of 22 years, this is relating to something slightly different, isn't it? It's not a recovery. Am I right in thinking this is because we're in surplus, and this reflects the reduction that employers will be paying rather than an addition?
Yeah, so perhaps it should. It's more like a deficit distribution period rather than a recovery period. Yeah. I can see if we can come up with some more sensible wording for that. Yeah.
Because if it was a true recovery period, we're limited to 20 years, aren't we?
Yeah.
It's all right. was more just to make sure I understood what was going on there. Right. Any other questions? Okay. Item 8, the draft annual pension fund report and accounts. Off you go again, Nick.
Right. Thank you, Chair. Yeah, this is to present members of the board with the 2021 draft unaudited, I should say that in quite loudly, draft and unaudited report and accounts for the Teesside Pension Fund. It's just asking that members note them, really. There's no specific financial implications. I'm also asking that if members spot anything that they don't think looks quite right, please tell me, because these are still draft, and any comments gratefully accepted. We don't expect the main numbers in them to change, but there might be some impact from whatever the auditors say about them. There's some performance information here, just to say that really they're reflecting a really good recovery in global equity markets. It was particularly strong in the US. It's been a bit less strong in the UK, but there's still been a significant market recovery. I think when we were looking at some performance figures, I think to the end of March, it went up by about 26% or something like that in a year, which I'd have that every year. Thank you very much. So some of that, a lot of the recovery was because of the sort of quick and significant intervention from governments, and also there was significant rapid scientific development, really. I mean, I'm still quite amazed by how fast they developed a vaccine when we were told, several vaccines, multiple vaccines even, when we were told it was going to take, could take years. It's very impressive. So the financial performance of the fund, it was incredibly positive. It was up £847 million in the year, which took the fund's value to over £4.5 billion. That more than offset really what was a very negative performance in the previous year, and it puts the fund put the fund on track with the actuary's expectations. Really, if you look at what the actuary was expecting the fund to deliver on average, then we're on track. Or certainly we were at the 31st of March. So that's good news. The fund membership continues to increase, sort of slightly. Number of active members has gone up. Number of pensioners has gone up. Number of deferred members has gone down a little bit, but still the membership for the fund is on an upward trajectory. There's a valuation. The next valuation of the fund will be as at 31st March next year. So I guess the really important value of the fund is what's a fund worth on the 31st of March 2022 rather than 2021. But we'll have to wait and see. The next steps really, they're presented in draft form here. As I say, the main numbers and outcomes aren't expected to change. We might need to change some other things as we review it. The audit process isn't complete. When it is complete and fully audited, the annual report and accounts will be published on the pension fund's website. So that was it. Thank you.
Thank you, Nick. Any questions or comments? It's interesting looking at our costs on page 88. When you add up the various administrative costs, which have sort of changed in how they're reported, largely because of border to coast coming into the picture. But 5 years ago, our costs were under 5 million a year. They're now over 7 million. Presumably, most of that increase in cost is down to the costs that we incur with border to coast.
Sorry, I lost you for a little bit there, Colin.
Right.
You're comparing, was it 5 years ago to now?
Yeah,
in terms of
page 88.
Yeah, in terms of admin, investment management, and oversight and governance added together, sort of thing.
Yeah, that's right. When you add those together, 2016-17, and the next year it was a bit under 5 million. Since then, it's been getting towards 7.5 million.
Yeah, I think that's probably correct. I mean, we could do some. I'd have to do a bit more analysis to work out where the increases were coming from, if you like. And there's a breakdown in here, I think, of further breakdown of the expenses, or comments on the expenses. So if you look on page 91,
yeah,
it's got at the bottom of page 91, it's got admin expenses 11% down on the previous year. Investment management, an increase, includes border to coast management fees of 1.6 million. Private equity infrastructure alternative investment funds 1.4 million. So some of it might be to do with the nature of what we invest in rather than just border to coast, if you see what I mean. So as we invest more in private markets, you're going to see higher investment fees,
yeah,
than just public equity, which is typically cheap to invest in.
yes.
So as we change our sort of investment mix, it's probably a consequence of that as well. But yeah, we can have a look at that and see if we can get some better idea.
I think it's. I mean, I want to come back to performance of border to coast in a minute, but I think it's worth us continuing to be aware of the increased costs that come from border to coast. That's not necessarily to say that it's not a good investment, but I think we do need to keep sight of it as we go forward.
Absolutely.
Page 94, the wretched asset allocation strategy again. I think that table is now out of date. Correct me if I'm wrong.
Well, I think it was correct as at the 31st of March 2021.
Okay. Right.
Which is what we have to show.
Okay. Yep. Fair enough. Right, the last one from me, if I can find it. Yeah, it's page 112, although really what's on page 112 doesn't matter too much. The point about this part of the report is that we're looking at performance, and what's being measured is the performance of the fund, which is entirely reasonable. In other words, how collectively the pension committee and its officers have invested. Linked in with that, but not explicitly reported on, is the performance of border to coast. Until border to coast came along, there was a strong argument that said, well, really, it's down to the committee and its officers, how they manage the portfolio, who they employ as managers of the funds, which companies they go to, and so on. And there were not quite 1 million and one to choose from, but there were a lot to choose from, and that really was, in a sense, where the officers' expertise came into this. That's no longer true to the same extent, because we're now committed and indeed obliged to put the most substantial proportion of our funds with border to coast, and we've been through all the reasons for that. We recognise it. This board was more or less comfortable with it, given that there was no other direction that we were allowed to move in. But we still, excuse me, we're still left with the issue of how, for the future, can we ensure that the performance of border to coast is comparable to the other pooling organisations. We, in effect, are obliged to stay with border to coast. That's the deal, and I'm not suggesting that we tried to step back from that, and we certainly can't. But at the same time, not only do we want border to coast to be achieving its targets, but we also need to know that those targets are challenging and bear comparison with the other pools that are in operation. Do we have any mechanism for doing that? And do we in the future anticipate that the performance of Border to Coast will be reviewed in a similar way to the way in which the performance of the whole fund is?
Well, I'm certainly not aware of anything at the moment that could do that for us. But yeah, I'm sure the government would dearly love to know as well whether Border to Coast are performing as well as the other 7 pools, or where they are in that sort of performance league, if you like. But it's very difficult, and I'm not sort of wanting to make excuses for them here. It's difficult for a number of reasons, because obviously Border to Coast has got multiple different investment strategies, if you like. And so they might be doing really well on equity performance, but not quite so well on bond performance, in which case, where do you rank them? And at the moment, we don't care about how they do in bond performance because we don't have any bond investments. But at some point in the future, we will. So at some point, we will care. So it's kind of, it's tricky to say the least. And I think what they're doing currently is trying to have a consistent way of identifying costs as a starting point. So money, information is being collated in relation to the cost of each of the pools, and we've sort of contributed to that at a fund level. And but I think it's difficult to get, because there's no central body imposing you must do it this way. It's difficult getting consistent information that you can realistically compare between pools. But you're absolutely right. It would be great if we knew that, and it'd be important to know that. It'd be more important going forwards to know that as well, because it's all very well saying, for example, Border to Coast have picked 1% above market indices as their sort of standard for internally managed equity. Now, it's great if they can achieve that, until you discover that Central might have picked 2% above and they're achieving that. Yeah, but we don't have that information at the moment. But yeah, it's something that collectively we can press for.
Yes, I mean, clearly it's not something that this committee or this board could be pushing forward on its own. But as far as, in effect, the industry is concerned, there needs to be a pretty hard look, I think, taken at how the pools are functioning. If for no other reason, then it's going to be important that the pools are seen to operate, because there are those of us who have a suspicion that this is the first stage of the government taking control of huge amounts of assets, which it could use for goodness knows what purpose. We're all aware that local authority pensions are very unusual in being, in our case, fully funded, or in other cases, hugely partially funded by contributions, as opposed to, for example, the civil service pension scheme, where it's the pensions that are coming in that are funding the pensioners. So we are very different, and we're very unusual. And as I say, it's a huge crock of gold that it would be very attractive for a government to get its hands on, if it could demonstrate that funds weren't being used appropriately. I won't ask you to comment on that, Nick. If there are no other questions, we'll move on to item 9, which again, Nick, is for you, an update on current issues.
Yeah, there's just a couple of issues that I wanted to bring to the board's attention here. One of them is about the cost control mechanism, which I believe we've already touched upon, which is basically a way of making sure that when they introduce changes to public sector pension schemes, public service pension schemes, there would be a check to make sure that a mechanism for checking whether or not the cost of providing a scheme was falling outside of an agreed cost envelope. So the idea was, if schemes became more expensive, the cost could be borne by scheme members and not just the taxpayer. So the mechanism for doing that is called the cost control mechanism. An assessment's meant to be carried out every 3 or 4 years, depending on the scheme, every valuation effectively. And if the cost had increased by more or decreased by more than 2% of pensionable pay, then there'd be some correction required. So that was the idea. But when, unfortunately, the first assessment that they did under this method came out with a result that they didn't like, really, that was considered perverse, because it seemed like the scheme wasn't generous enough and that members' benefits should be increased at the same time as employers' contribution rates were going up anyway. So it looked like a double hit on employers, and it seemed like something had gone wrong effectively. As it happened, the increase that was meant to happen or could have happened in the local government pension scheme and in the other schemes was put on hold because of this Mcleod case I've spoken about already. So in the meantime, they identified that the government lost a court case, and which would increase the liabilities of the schemes. So they put on hold any sort of cost control mechanism changes, but while they worked out what the actual cost of this other real impact on schemes was. So in the meantime, the government actuary was asked to do a review of this cost control mechanism with a view to making it more sensible, if you like. And the Treasury has then gone forwards with some methods, some other proposals from the government actuary. Well, actually, but that consultation is ongoing at the moment, so we don't know what's going to happen, unfortunately. But we will do when the government decides what it's going to do with the cost control mechanism. But personally, I think what will happen is they'll put in place something that makes sure that they won't be in a position where they're going to be increasing members' benefits in a situation where it's unaffordable, effectively, to the public purse. But how they get there, we'll have to wait and see. There's some comments set out in 4.4 from Hymans Robertson, another actuarial firm, pointing out the fact that there's some other issues with the local government scheme because we set contribution rates locally. So every single one of the 89 or so local government pension schemes, they've got different approach, slightly different approach, perhaps. So
Nick, you've gone quiet.
UK gross domestic product will increase, which is obviously a big countrywide global factor rather than individual local factor. Yeah, so that was the consultation that's happening on that, which is ongoing, and we'll see what happens as a result of that. And the other issue I wanted to point out and bring to the board's attention was to do with climate change and the disclosure of climate change information. So basically the government's requiring private sector pension schemes to provide quite detailed information about what they think the climate related risks and opportunities are in their sort of asset mix. And from October this year, private schemes that have got assets of more than 5 billion, and October next year, those with assets of more than 1 billion will be required to have appropriate governance arrangements in place to identify, assess and manage climate-related risks and opportunities. And a lot of that, the starting point is around measuring what your sort of funds, investments, climate impact is, what their sort of carbon exposure is, if you like. So, which is possible to do. It's very difficult to do. It's easier to do with things like listed equities. So it's easier to do with companies because companies tend to have information they can provide on that. It's less easy to do on private market investments because the information you need won't be publicly available necessarily. So this is very much the government's direction of travel on climate change, requiring disclosure from pension schemes. This doesn't apply to the local government scheme yet, but they have indicated that pretty soon they'll be introducing regulations that will impact the LGPS in the same way. In the meantime, we're in ongoing discussions with Border to Coast and also with partner funds in Border to Coast to look at whether we can collaborate, do any joint working on say, measuring carbon exposure. And we've also made an initial contact with all our investment managers to try and understand what reporting details were available in respect of each of our investments. So it's kind of it all sounds somber, but it's kind of a good news story, really, because it's requiring investors to have some responsibility and to get behind reducing carbon emissions at some point in the not too distant future. So that was that. Thank you.
Presumably, I mean, from the report that we had from Border to Coast a couple of meetings ago, climate change is one of the areas that they're pretty much on top of in terms of reporting and analysis.
Yeah, they're doing quite well. Certainly, as I say, particularly in terms of their listed assets. So in terms of equities, which is the easier bit, they're still working through what it means to get and to report on climate information in respect of, say, infrastructure investments or private equity investments or even bond investments. It's not that straightforward, but yeah, the one of the good things about pooling is they're better resourced to do this sort of stuff than we ever would have been at Teesside.
Yeah. Any questions for Nick on that? Okay. Move on to item 10, which is the work plan update, which I think becomes more of a, it's always been an active document, but it becomes more active, I think, given the changeover of composition of the board. Take us through the key points, Nick. I think it might be helpful as you go to say where you've got to in terms of assessing the amount and the nature of the external support that might be provided to assist with this.
Yeah, this is really an update, as we say, because a couple of years ago, I think the board put in place a work plan. And the point of the work plan was to try and put some structure around what the board looks at, because if you look at the guidance around pension boards, there's a lot of areas that are supposed to be reviewed by pension boards or assessed by pension boards. And this was just an attempt to put it into some sort of diary, if you like, of when we would do different bits or when the board would look at different areas to make it more manageable and sensible. So if you look, for example, at 4.3, the regulator's website, it's got areas of governance and administration that a board needs to look at. There's a list of governance and administration issues, quite significant. There's also sort of further guidance available. The links I put in this document as well. And so what I've done in Appendix A, which is on page 158, I've put in place a suggested timetable of when things get done and what gets done. Obviously, as Colin said, this is very much a work in progress, and feel free to change it or amend it or disagree with it or add things or take things away. And in Appendix B, the next page, I've just tried to marry up the different bits that a board is meant to do according to the guidance, and to say how we're going to achieve that, how we think we're doing that, just a sort of checklist, really. And in terms of your question about support and how you can get support and input, then I would say that probably is an extra column, even, if you like, because there's some stuff that we can do internally, but there's some stuff that we would benefit from getting support from, and some of that might be internally at the council, if you like. So we've got a procurement review down there. So I'd be looking to get someone from the procurement team to come and have a look at the procurements that we've done and talk us through them, or explain how we could have done them differently, or might want to think again. Or it might be that some of the administration related stuff, particularly on communication to members, for example, we did this last time by getting XPS to come along, getting Paul or Graham or colleagues to come along and talk about what they've done and what documents they've provided in terms of communicating with scheme members, or how they've adapting the website, or so I think some of the, you're absolutely right to say that we need some help on this, but it might be that we can resource this internally, if you like, and if we do need to resource it externally, then that shouldn't be a problem, because the board is empowered to spend some money if it needs to. I believe I'd have to check on the Constitution, but I think it might need agreement from the chair of the committee or something, but it's not an onerous process, I don't think.
I was really, I think, just reflecting on the fact that I think it had been agreed that there would be 40,000 put aside, up to 40,000, to facilitate training for the committee and the board.
Yeah.
It was really just thinking.
Well, I think that is I think that as an extra. I think that's on top of all this, if you like. So the training for the committee and the board. I've had some an initial conversation with a bit more than an initial conversation with Hymans Robertson firm of actuaries, as well as with Aon, our actuary, about what sort of training support they can offer to board members and committee members. And yeah, there's some different and useful propositions there. So I guess I may as well tell you. Well, I've got you. The one that the reason they're different is the one that Aon offered was very much a sort of standard in a way, in the sense that it had training days lined up, and members would attend remotely, and then there'd be some interaction and discussion about different topics. Whereas the Hymans Robertson version was very much a sort of modular training online sort of thing, where you go in and or watch a video about something that might be 10 minutes long or 15 minutes long. So it was more sort of do it in your own time, very much similar to the pensions regulator training, if you like, except more varied and more focused on local government pension scheme. So there's a couple of different options out there on that training front.
Thanks, Nick. I mean, it's clear. I mean, for everyone, but in particular for people who are new to the board, it's clear that a variety of training will be needed. I'd welcome any comments from members at this point to help Nick in taking things forward. I mean, clearly you'll need to return to this in the autumn to get into more detail of what's going to follow on from here. But any initial comments I'd welcome. Nothing from anyone? Okay, right.
I think no, I was just getting myself. I was on mute. Yes, I think it is. It is something we must consider. And is there a way that you could blend the two, or do we have to do one or the other?
I'll have to see what the 40,000 covers, I think.
Yes.
No, I think you're absolutely right. Yeah, there is a way to blend the two. Yeah. We could certainly look at that. But I think what the scheme actuaries are trying to come up with is something that you buy as a package, if you like, which is fair enough. And to be fair, it isn't in the context of this budget that we've got, it isn't particularly expensive. I don't think either of the options. No. And if we could also make it available to the committee as well, then that makes it more cost effective as well. Yeah. No, you're right. Yeah, a blend of two approaches would be better. Then you could also get a view about what you could try it for a year and see what people get the most value out of.
But because there are different ways of learning, aren't there? Everybody has a different way of learning, and it might be better. Sometimes I think that it is better to have a blended approach when it comes to training, so that you can actually take things in.
Yeah.
Okay.
Yeah, I'm sure that's right. And I mean, I think the other point is that we agreed at a couple of previous meetings that there's quite a lot of commonality in terms of the training that's needed for committee members and for board members. There's a lot of overlap there. and that can be become a more cost-effective way of doing things. But I'm sure you're right that there needs to be a mix, doesn't there? I think those of us who've taken part in the online training have felt that it's been fairly effective and quite non-threatening, really. Possibly apart from the last one that we did, which seemed to be asking quite a lot of in-depth questions about things that were rather esoteric. But at least we could do that in the privacy of our own homes rather than in an embarrassing situation with lots of other people around us. But at the same time, having physical meetings from time to time where it's possible to discuss and to talk about things that are perhaps a little bit trickier to understand, that's also useful.
One other thing I want to mention, I should mention, is it's been brought to my attention recently. We get like a weekly update from Border to Coast about what's going on at Border to Coast. And the one that came out this week, or the end of last week, reminded me that they are doing some training. They've got a couple of online training sessions. I think it's badged as being for new committee members. I'm sure it'd be interesting and useful to board members as well. So I can certainly have a look at circulating that to the board to see if they're interested in attending. I'm sure there's no cost and no commitment, and it's just whether you've got the time, really.
I'm sure it would be helpful to circulate that information.
Yeah. And
I must say, I mean, I know it's not directly relevant, but I felt that the quality of the presentation that we had from Border to Coast at, I think it was the last meeting, I thought was quite professional, and it was clearly tailored to address some of the issues that we raised. So if that is the degree of their responsiveness, I think that's a good start.
Yeah.
Any other comments or questions?
Just one from me, Chair, if that's okay. Yeah. Just to achieve some of that blended training, the LGA recently put out a flyer to advertise their governance conference. It's not until it's early next year, but they're going to offer that virtually and in person next year for the first time. And that's aimed at pension board members, committee members, and others that are interested. So it might be one to to add into the mix.
Yeah, thanks. I'm sure that's right. I mean, I've been struck at the number of communications that I've had from a variety of organisations offering conferences of all sorts, and clearly some of it is partly to promote their own wares and to increase their profile. But the content of some of it, on the face of it, does seem to be quite valuable. I don't know whether it's an area that perhaps Nick, you or your team could assist with, simply in terms of pointing people in the direction of the conferences that on the face of it look as if they might be relatively useful, as opposed to pushing particular products.
That's a really good idea. I'll have a look at that.
Yeah. Okay, thanks. Anything else on that item? Okay. Item 11, XPS Administration Report. Paul, at last, thank you for waiting patiently.
That's okay, thank you, Chair. Good afternoon, everybody. Yeah, it's a pretty standard report, I think, really one which you're used to seeing delivered by Graham. Some of the headlines to start off the report, I think, have already been covered really by Nick's update previously. He's mentioned the Mcleod case. We are awaiting legislation towards the end of the year on this now, which will tweak some of the rules within the scheme. And I think that the remedy for the local government pension scheme will be achieved largely by automation, without a great deal to do for members. So hopefully it's not the huge piece of work that it was made out to be at the very start. So we await some legislation on that with a very keen eye. DWP have launched a consultation on pension scams, and this is, I think, in response to a lot of activity around scams generally in pension schemes. We're seeing a lot of members, not particularly within the LGPS, but elsewhere where they've transferred benefits out in the past, and now that's coming back to bite them. Now they've found that the schemes that they've transferred to weren't as guaranteed or weren't as good as they were made out to be. So there's a consultation on scams, and that will probably aid another code of conduct from the regulator, and perhaps another amendment to their online training. I think you referred to it earlier, the recent module on scams that they've recently put out already, so that might get an amendment as well. We've got a rebrand on the Prudential. There's a couple of issues with the Prudential at the moment, I think, which they're trying to remedy in terms of divesting funds and communicating out, but I think that's getting sorted, which is good news. COVID-19 for XPS. Our trial on My XPS My Choice starts in a couple of weeks' time officially, and this is where everyone's been given the opportunity to work either from the office, from home, or a mixture of the two. So that's being trialled in August, and we'll let you know how that goes. I mean, hopefully, with the presentations that we give to you showing the service stats, it will speak for itself as to how that's gone, because we don't envisage any drop whatsoever in service for you, but we'll make sure that that is the case, and we'll obviously demonstrate that within the reports as we would normally do. The membership movement moving forward, that ties in with what Nick was saying earlier. Actives and pensioners are going up ever so slightly, with the deferreds dropping at the same time. Member self-serve, these numbers are still quite low, but we are looking to, and I think we've mentioned this before, look to automate a key for scheme members and send them out as a big batch. So what we're basically doing is we're right out to the members to say, this is your key to get online, and if they use that key and the URL that we give to them, they can get straight into the system to register. So there's security built into that, but it's very less manually intensive for the scheme member and for us back at XPS. So we're hoping that that will be a big drive to get people online, which will supplement the other communications that we send to scheme members as a matter of course. So there's no compulsion for people to be online. We aren't trying to mandate people, nor would they lose any information or communications by going online or by not going online. It's another way of trying to engage with the scheme members. So the stats, as we've been presenting now for probably the last 3 or 4 meetings, are all over the next few pages. Hopefully you find that information useful. And as I say, if we can get this activation key working sometimes in the next couple of months, you'll see a big spike in member uptake. The Guaranteed Minimum Pension Reconciliation Project is ongoing, seems to have been ongoing for a long time now, but it is a huge national exercise which covers just about every pension scheme in the land with contracted out benefits. So that continues to be worked on, and we update Nick and colleagues within the Administrating Authority I think it's on a monthly basis, to let you know how things are going and what the next stages are for this project. No complaints as such to report from this quarter, but there's 2 internal dispute resolution cases that are ongoing. One relates to, it was an issue with one of the employers, so it's more an IDRP against the employer than the fund itself. But we do have one that is against the fund, and this is where there'd been a misquote of benefits to the individual who had 2 different periods of membership within the fund. So I think there was a little bit of confusion as to which record this amendment was supposed to be allocated to, and as a consequence, we've slightly misquoted a benefit. So that's going through the internal dispute resolution procedure at this moment in time. So 2 out of what, 71,000 or so members. We said at the committee, it is a low number, but that's not to say that we won't discount just on the basis of low numbers, because we do try and learn from any complaint, expression of dissatisfaction, or IDRP case that we have to deal with. And if there is a change that we need to make to our process or to the way that we approach something, we'll be happy to make it if it's for the benefit of the scheme members and their experience. Moving on to the data and the analysis of that, it's pretty much it's a standard item and almost a standard number, I think, on the common data scoring. We've got 97.07% as a common data score. And we've talked, I think, extensively in the past about why we can't hit 100% for some of these. The anomaly being the addresses and typically the gonaways that we have for deferred members. So whilst we're doing quite a bit of work with people who we don't have addresses for who are active, so we're speaking to employers within the health checks that the employer liaison team do. With deferred members, so that's those members who leave the fund but without an immediate entitlement to a benefit. If we lose them, sometimes, unless they get in touch with us, it's difficult to find where they are. But we're using the output from the National Fraud Initiative to try and trace some of those members, which will reduce down the amount of gonaways on the deferred cohort that we have in the fund, which will in turn increase the common data score. So that's the main one that we can do something about, and all the rest, I think we've spoken about why we can't achieve 100%, and that's the children's NI numbers, things like that, and different titles who don't pass the common data tests. Unfortunately, we are no further forward on the conditional data scoring, so we have been saying again for some time that we've got 7 of the 22 Scheme Advisory Board tests in place and running. We are trying to build internally the other tests that would allow us to complete the full conditional data suite. But this relies on our business services group team, who for quite some time have been embroiled in the year-end and production of annual benefit statement work, or the project-based work that sits behind that. So they've been a bit stuck over the past 6 months, but I think as soon as we get out of the annual benefit statement exercise and the year end that precedes that, then they'll start to work on the conditional data. I think we are still ahead of quite a lot of other administrators who don't do conditional data yet. Some have only just really started putting common data into the scheme returns that are due towards the end of the year. But we've got 7 of 22 and we're not resting on our laurels. We do want to try and build on this conditional data as quickly as we can, because ultimately it benefits everyone. If we can test and prove that the data that we hold right across the board, whether it be common or conditional, is as good as it can possibly be, then the member gets the best possible service and the quickest service from us. It cuts down on the amount of, I suppose, intensive analysis that we need to do on records, trying to find pieces of info that's potentially missing. And it makes the whole service just much, much better and seamless, which is exactly what we, and I'm sure yourselves and the scheme members, would like to see. So moving on from conditional data, we've got the satisfaction. That remains very constant. One thing I would say about this is we are trying to put together something called Smart Survey, which is going to be an online satisfaction form which scheme members can fill out as and when they wish to. So as well as sending out a satisfaction survey with the retirement options, which is what we do now, we can also start to capture some general feedback, whether that be about the service, the website, a communication that we've put out, anything that they want to. So we're looking at that, as well as a bit of an initiative to help with the website launches. What else have we got on here? We've got some statistics for the website. So I was speaking to Michael. So Michael's the comms consultant who was employed last December, and he tells me that in the last month we've had an increase of 42% on web traffic generally to the Teesside Pension Fund's new websites, and there's 15.5% increase in new users So it does look as though a lot more people generally are viewing the website, an extra 42% of page views, and we've got 15.5% brand new people looking at the website as well. So that's really, really encouraging. We've just put onto the website as well something called, it's a tool called Recite. So Recite gives you that full accessibility that covers visually impaired, hearing impaired, and it also allows you to convert the website very, very quickly into many, many different languages. So that's just gone live on the website as well, which is really, really good. Let's see what else. So what we're looking to do here is to show you the updates on the website traffic map. We'll give you, anything that we can find that will demonstrate what we're doing with the website. We'll put into that map for you. With employer liaison, we're still doing the employer health checks. And what Laura and Jenna are saying is that now we're starting to see people more face to face. As you'll probably know, we've moved into our new office, so we've got a bit of space here to conduct socially distanced meetings, which we'll continue to do until people are comfortable and confident in meeting up face to face. So we are trying to encourage employers to have those face to face meetings, which we're calling the employer health check. So it goes through a variety of items to make sure that the employers are aware of their obligations and where we are in any given period in the year. Because there is a cycle, an annual cycle, where employers have more to do sometimes than other times. An example of that would be at the moment, I've mentioned annual benefit statements already, is the submission and checking of the year-end files. So every one of our employers from the 4th of May has sent us in a year-end file. This covers everything that the employees, the scheme members, have paid in terms of a contribution, and it confirms to us the amount of pay that's been received on a final salary basis and a career average basis as well. And then there's a scheme return, which is also submitted from some of the employers. So Laura, Jen, our service delivery team and our business services group teams have been going through those year ends, and what we'll do is make sure that they're correct. We load them into the Altair system, and that in turn allows us to produce the annual benefit statements. So benefit statements for active members are due by the 31st of August, and we are on track. Every single employer has submitted the necessary information now, which is great. This year we're staggering our timetable, so the deferred members are due to receive their deferred benefit statements anytime. Well, the submissions have been going in from Friday and will go in this week as well. So they've got all the data, need the templates, and then within about 2 weeks' time, the deferred beneficiaries will receive their deferred benefit statements. And then towards the end of the month, the end of August, the active members will get their statements. So we've committed to sending all information to print by the 4th of August this year for the active members. So they will receive their annual benefit statements on time and in line with the statutory disclosure requirements. We then move on to the pension savings statement exercise, which is the final piece of the jigsaw from the year end. And this is where anyone with a pension input amount of £40,000 or more will, by the 5th of October, receive a pension savings statement. So moving on to, there's a late payment table in there that confirms in April we had 8 late payments, and I think this is just due to the busy nature of April for a lot of our scheme employers, but they did all come in eventually, most within 10 days and one after. No late payments for May, but we obviously continue to keep a very close eye on late payments of contributions coming in. In terms of the performance, all of the usual graphs are there, but if we take you to the final 3 pages of the report, you can see that for the last quarter that we're covering here, for January, February and March, we've got 100% of KPIs covered, which I'm very pleased to report to you today. So, I mean, that's the end of the formal report, but more than happy to take any questions that you may have.
Thanks, Paul. Any questions for Paul? You mentioned the issue about conditional data, which is something that we've been discussing for a number of meetings, I think. And the report that you presented to us says that discussions are ongoing with Aquila Hayward, but not a lot of progress has been made. The implication seemed to be what you said. What sort of timescale can we expect to see something moving forward?
Well, we've been trying to push this for some time now. It's frustrating because we want to be able to show that we've got all 22 in place and that we can test against them on a monthly basis. That's where we want to be. We can get there with Haywards, but we need to pay them a lot of money. We can get there within XPS, but we need to pay XPS money, which we don't obviously want to do because we believe that we can do the tests and control the tests much better if we create them ourselves, and we can then test against them on a monthly basis, which is the best result for you, and it comes at no cost. But we do have this balance of we haven't given it to you yet, which it gets to a point, I think, where you say, well, if we can't test against our conditional data, at what point does the scores that we gave you previously become completely null and void because we've not tested for so long on new tests? I mean, I think, Nick, we spoke a little while ago before in the fact that we've got a bit of leverage here because the pensions dashboards are going to come online in 2023. And this is where public sector pension schemes are going to have to push information to an online portal so that members can log in and see all of their pension interests. And that includes public sector pensions as well. So we think we've got some leverage to push back against the team. It sounds a bit daft, but it's an internal battle. I mean, if I can ask them to start pushing tests out, so we've got another 2 more by the end of August. See if they can work on a minimum of at least 2 tests per month, and get more if they can. You know, if I commit to that, at least you can see them to start increasing. We'll try and get to the 22 as quickly as we can possibly get to, but in terms of a full and final date, I need their buy-in. So I can push it and I can say we've got an action that's coming directly from the pension board. We must see progress on this, and I think we can get some action on it.
Well, I'll ask for Nick's view in a minute, but I mean, it seems to me clearly I'm not the person to be getting involved in what the contractual situation is, but it would seem to me that XPS is under an obligation to be providing accurate data, and it's an internal issue for XPS to sort out rather than a suggestion that you should be asking for more funding. But I'll ask Nick what his view is on this.
Well, I think contractually, I've inherited a position which sets out what XPS are required to do. However, we're about to go through a retendering exercise on this contract, so that gives us some scope there as an ultimate fallback position, if you like. But I'd much prefer some agreed action to come forward, like Paul suggested, where they agree to look to do 2 a month, so we can come back and look at the next time we have a board meeting. We should have another 6 to 8 extra ones added on, which will be okay. That'll be progress, because I think the frustrating thing is to see nothing happening.
Yeah.
So yeah, and I think there's further pressure coming on this side of things as well, because we expect the good governance project. One of the things it said was that, which the pensions regulator is going to be sort of implement, or the regulator is going to be implementing, is around, one of the things there is around targets, and one of the targets will be whether you have you know, how good your data quality is. And that's going to be measured by whether you meet your conditional data scores. So if we're not able to say that's not going to look very good, and now that isn't in place yet, but we expect that to come in force in the next year or so. So it doesn't do any harm to start preparing for that now. But I'd be quite happy if we take Paul at his word and see if he can go back to his superiors or whatever and say, look, we've had this from the pension board. We'd like to see at least a couple of months of these come through, and we want to see some progress in this area.
Would members support that approach? Yeah, okay. So if you could take that back, Paul, that the board would actually like to see some progress being reported meeting by meeting, so that there are definite steps forward being taken at each meeting, rather than simply a hope that things will improve. And obviously it's not just an arbitrary statistic, because we know that this is something that we're going to be assessed against in the future, and it's going to be better for everyone concerned to be ahead of the game rather than trying to catch up once it becomes mandatory.
Yeah,
Okay.
yeah, definitely.
Thanks, Paul.
Thank you. Thank you.
Any other comments or questions? Okay, so I think that completes the agenda. There are no other urgent items which I've been told about, so I think that ends the meeting. Thank you for your attendance and your support, and farewell, over and out.
Thanks, Colin.
Thanks, everyone. See
Bye,
you later.
everybody.
Cheers.
Bye-bye.